Hello there. My name is Cyrus McCormick, and I'm going to tell you a little bit about the things that I invented during the course of my life because I was considered the most influential person to revolutionize American agriculture. Something you should know is that when you're trying to do a business without advertising, it's like winking at a pretty girl through a pair of green goggles. You may not know what you're doing, and nobody else does either. She damn sure won't see what you're trying to do. So when you're doing that, you have to have an indomitable perseverance in business. Properly understood, it always ensures an ultimate success. With that said, I want you to meet Mark and check out StockMarketJobber.com's weekly newsletter. It's revolutionizing the way traders and investors view the market. And, Professor Mark, you ready yet?
All right, Mr. Cyrus McCormick, thank you very much. And thanks for being here with us this week. One of our important people in history, and at Stock Market Jobber, not only do we try to teach you about the markets and how to trade them, we also teach about history because it's pretty important. History repeats itself, and that's because the human nature doesn't change, right? Just like now, and just like back when Mr. McCormick was alive, there were people who experienced buyer's remorse. There were people who experienced seller's remorse. There are people who want to be told what to do. So the names have changed. The names of the companies have changed. The players have changed. But one thing that hasn't changed is human nature. So one of our basic principles is that certain price levels are more important than others. And you got to know where these levels are if you want to be successful, at least in my opinion. We sorry about that. Yeah, you want to know where these levels are. These are called support and resistance levels. Support are levels where there's a lot of buyers, where there's more demand than there is supply, or more buy orders or buy interest than there is sell interest. So when a market is heading lower and it gets to a support level, sometimes it stops going down and it reverses. Resistance is the opposite. It's a large group of sellers. So when a market or a stock is moving higher and it gets to resistance, there's a good chance that it stops moving higher. There will be more shares for sale than there are shares to be bought. So because of that, it puts a top on the market. So these levels can remain intact for a long time. Sometimes it could be months, sometimes it could be even years. And this is what we refer to as market memory. So if you hear people use that term, that's what they mean. And then levels that were resistance can convert into support, and levels that were support that can convert into resistance. So we don't really need to have an incredibly complex system to be a great trader. It's just understanding the concepts of how some levels are important, some are less important, what the trend is, and what the momentum is. And that, I think, is kind of the secret. So let's take a look here. Oh, actually, this is just a little bit of just an overview of this particular levels uh, to watch this week. So at this point, I'm going to bring Mr. McCormick on again. He just wants to tell um, I want him to tell you and to tell me just a little bit more about his history and what he did. So, Mr. McCormick, the stage is all yours.
Thanks, Professor. I founded the McCormick Harvesting Machine Company, and I'm also considered to be one of the most influential persons in American agricultural industry. One of my famous inventions was a mechanical reaper harvesting tool, and it was pulled back, blade pulled behind two horses. I'll explain it a little bit later. I probably shouldn't have gone that far, but as for revolutionizing agriculture, my business flourished, and in the process, the American industry of agriculture was also diversified. We're planting different crops in America now because my machine cut shit so fast. For my contributions, they gave me countless awards and medals. So, Mark, what's going on in the markets? How are they going to make money for people this week?
All right, so this is our S&P 500. It's actually the spider or the ETF that follows the S&P 500. And this is what we look at because this is what a lot of people trade. But I just want you to see how we can see here how certain levels are more important than others, and that's certainly the case with this 390 level. Now back here in May, we can see it was support. A lot of people stepped up and bought it here. Remember what I said? Markets that are trending lower tend to stop when they get to support. If they're trending lower, it's because there's not enough demand to absorb all of the supply. So sellers are forced to offer their shares out at a discount. And this is what forces things into a downtrend. But when we get to a support level, there's enough buyers or buy orders or buy interest to that the sellers can sell all they need to, right? The buyers can just absorb all the shares. And a lot of times we see reversals. Now check this out. Over here in June, it falls below this price. So a lot of the people that were buying now regret doing so. They become remorseful buyers and they tell themselves, I shouldn't have bought this stock. If I can get out at break even, I'm going to. So they place their buy orders at the same price that they sold at. Actually, I said that backwards. I'm sorry. They place their sell orders at the same level they bought at. So they bought here and they're selling here. This is remorseful buyers placing sell orders. Now we see the opposite principle. What was resistance turns into support. Pretty amazing, right? This is due to seller's remorse. People who sold thought that they made a great trade when the market went lower, but let's assume they held on to, let's assume the market rallies and gets back above the price that they sold at. A lot of these sellers say, damn, I have seller's remorse. I shouldn't have sold my shares. I'm going to place my buy order. Well, I want to buy my shares back, but I don't want to pay more than I sold them for. Just like here, people want to get out at break even. They say, all right, well, I made a mistake, but if I can get out at break even, then I'm going to. Say they place their sell orders here. Now that the market goes higher, the people who sold, a lot of them say, I should have held on to my shares. I'm going to buy them back, but I'm only going to do so if I can get them for the same price I sold them at. So as a result, they place their buy orders at the same price that they were selling at. And if there's enough of these orders, what was resistance can become support. And we see a little bit up here, support becomes resistance. So remember, buyer's remorse. People bought here. When it went lower, they said to themselves, I made a mistake. Gets back up here, and a lot of these remorseful buyers are placing sell orders, and that's why there's resistance at this level. So when we know where these important levels are, it just helps us trade because it gives us a better idea of where the market's going to go. These charts are like roadmaps, and if you don't have a good understanding of how to use charts, it's kind of like being in a town you've never been in before without a map or a GPS system. You're just kind of not going to know where to go. So once again, here now in late October, resistance formed again at 390. So this is really an amazing kind of thing that people take for granted. Like people that are random walkers, they think the market can't be out-timed. Well, I know a lot of people that became very wealthy by out-timing the market. So don't believe that you can't do it, especially if you pay attention to the right things. But anyway, so 390, and then after this little sell-off this week, we found support there again. So if we head lower, I would be looking for some short-term support around, at least some short-term support around 390. My guess is eventually the market does go lower because, there's some stuff to worry about. We got the yield curve is so inverted. I mean, I know inflation's been coming down a little bit, but it's still higher than it should be, I guess. All right, now we are going to look at the different sectors. There are 11 sectors in the S&P 500, and some of them are more important than others at various times. Sometimes the technology sector drives the market. Sometimes it's the most important to watch the financial sector. Different things are in the driver's seat at different times. So by looking at what's going on behind the scenes or underneath the hood here, it gives us a better idea of what could be going on in the broader market or which way the broader market is going to go. So here we have the technology sector, which is the biggest sector. And this chart is a little bit, I guess, kind of deceiving in the sense that this looks like a much bigger move than it is. This thing has been trading around 132, but the bottom has been around, 130, 129, and the top has been around 135 or so. So it's not that big of a range, but it's not to be surprised because this is technology, and technology tends to be more volatile than other sectors. So I would say for the time being, the jury's kind of still out here, not really sure which way we're going to move, but these are things that we look for. For example, if we do rally, there's probably going to be resistance up around here. And if you have the technology position and you're a trader, well, that could be a good place to consider selling. And look, it goes back to here. So we can see support became resistance, and it turned back into support, became resistance again, resistance. So former tops and former bottoms is a good place to look for turning points in the market. This is our healthcare sector. It doesn't get a lot of the attention that it deserves, but it is the second biggest sector in the market. And we could see here, this is a case where resistance stays intact. I wish I could work this damn pen. Come on, pen. Where are you? There you are. All right. So we can see here how resistance can stay intact for a while. This is what we call market memory, right? So it's been consolidating or in a trading range around this 133.50 level. If this thing starts to head south, it's going to be a good sign that the broader market's going to go lower. And if it starts to head north, it's going to be a good sign. So I know it's trader talk, like it may go this way or it may go that way, but that's the way the market works. This is kind of unusual, actually. Usually things don't hang out at these important levels for too long. I mean, look at this. It was only down here for a couple of days. It was only down here for one day. So sooner or later, this is going to make a break one way or the other. If you're an options trader, you might want to think about a straddle or a combo. And at this point, I'm going to bring Mr. McCormick back in so he can tell you a little bit more about himself. All right, Mr. McCormick, the stage is yours.
Well, it looks like I got a little ahead of myself explaining the reaper earlier. See, my invention was a horse-drawn reaping machine. I invented it back in 1831. Mark got a little ahead of me. What you think about my cool hats? He was top hats, boy, back in the day. They had some fine stitching on them. But the McCormick Reaper, it sped along the process of harvesting wheat and small crops and replaced the manual process of quartering that grain down with sickles and scythes, and harvesting them with the machine just made it so much easier, and people like me too. Paid me lots of money.
All right, thanks for that. This is our financial sector. This is where we have it's pretty obvious, our financial companies, banks, brokers, so forth. And this red line here is a Bollinger Band, okay? This is a way to measure momentum. Momentum is not volatility. Momentum is a measurement of how far something has moved from point A to point B in a given period of time. And most of the time, stocks trade within their historical or average trading ranges. Hence, that's why they're called average or historical. If a stock or a market gets lifted above that, we call that overbought. If it gets pushed below that, we call that oversold. And this is important because things that are overbought or oversold tend to revert back back to the mean. So this Bollinger Band here, this red line, is 2 standard deviations above the 20-day moving average. Now, why is that important? Well, because according to statistics, 95% of all trading should be within 2 standard deviations of the mean. So if we exceed this threshold to the upside, there's also one on the downside, but I didn't put it on just to make the chart easier to see. That draws sellers or buyers into the market because they're going to be expecting a reversion, and their buying or selling could actually move the market. So things that are overbought tend to reverse and go lower, and things that are oversold tend to reverse and go higher. It's especially the case if something is overbought and it gets to resistance, like we see over here, or if something is oversold and gets to support. This is our consumer discretionary sector. This is the sector of things where, at least historically, like luxury goods, things you don't need, versus consumer staples, which we'll look at in a minute, which are things you do need. But I don't know who decides up at S&P. They're the ones who run these spider ETFs. Actually, I guess I should elaborate on that a little bit. So there's 11 sectors in the S&P 500, and these ETFs are designed to track them. So by tracking these ETFs, we can see what's going on in the sector. Now, when I first started doing this a long time ago, ETFs didn't even exist. And these ETFs make our jobs a lot easier as traders or as stock jobbers, because look how precise we can get some of these levels here. I mean, look at this, down to 135 within a dollar. We had this one day here where we got a little bit lower, but these are big markets. You can't really judge whether something's broken just by 1 or 2 days. You got to have patience, and a lot of traders don't do so well because they don't have patience. But we can see there's some resistance here around 146.50, and when something gets to resistance and it doesn't break through, it tends to go lower pretty rapidly, and we say this is failing at resistance if it didn't go through. And this is because, think about it, there's a lot of sellers at this resistance level, and they start kind of getting the feeling in the market that there are other sellers around, so they start to undercut each other's prices because they want to be the lowest price in town. So whoever's buying comes to them, and it starts a cascading effect. So in general, markets go down faster than they go up, and that gives us easier chances to profit. Now, even if you don't trade options, there are ETFs that are designed to go in the reverse direction of the market. So that's something that we'll cover. You'll probably see it on some of my blogs over here, but a good trader can make money in any kind of market. A lot of people made money off the inflation trade at the beginning of the year while the stock markets were falling apart. A lot of people made money by buying these inverse ETFs. Next up here we have our industrial sector, and I think the most important or fascinating part of this chart is look where it ran into resistance, right at the $100 level. All right, this is what we call a psychologically important level. There's really no rational reason why there should be resistance at $100 other than people like to say, well, buy it if it gets to 100 or sell it if it gets to 100. People like to trade at nice round levels, and that goes for retail traders as well as institutional traders that I've seen. I spent 20 years as an institutional trader. I was a market maker. I oversaw the trading at a bunch of different hedge funds, and even some of the quote-unquote big boys, that's how they think. I guess it's just easier for humans to think that way. So look at how 95 was an important level. It wasn't 96 or 97 or 98. We just blew right through them. So if we go lower, I would be looking for some support around 95, and that's where we look for a balance. Oh, and what's that? Oh, yeah, sure. Oh, all right. Mr. McCormick just wants me to show you a picture of his machine, the Reaper. So let's check that out for a minute.
This is a hand build. Check it out. This is what my unit looked like. And this is one of the first ones we ever put out. I can't believe Professor Mark found this somewhere. It's amazing, this internet thing they got nowadays.
All right, that's pretty cool. Pretty cool. It was a revolutionary design. This is our communication services sector. This actually used to be part of the technology sector, but they broke it off because they thought it got too big. And when I say they, I mean the powers that be that run the spiders up at State Street in Boston. And a little more volatile here, but you can see right around 46 there was support, and up around 52 there's some resistance. Short term, I think we look kind of neutral, but if we start to trend in any meaningful way, I would be looking for, if it gets down here, a possible bounce. If it gets up here, a possible sell-off. And if it doesn't reverse, a lot of times when things get to important levels and they don't get through, or they break through, they make big moves. Because just like I discussed before, if something trades above resistance, it shows that the sellers, if the price trades above resistance, we say that's the resistance has broken. And it's not symbolic. It means that the sellers who created the resistance have left the market. So anytime you take supply off of a market, the buyers are going to have to pay premium prices, and this sets the stage for a move higher. Conversely, if something breaks support, it tells us that the buyers who created the support with their buy orders have left the market. So anytime you take demand out of a market, it sets the stage for the price to move lower, because sellers are going to need to offer their shares at a discount in order to get someone to buy them from them, and that could force a new downtrend to form. This is our consumer staples sector, which is where we have companies that are considered staples, right? Hence the name. Things you need, like food, medicine. So people perceive this to be a safer sector than some of the other ones. I don't know if it necessarily is, but at least that's the perception. This is a different way of measuring momentum. This is what we call our RSI indicator, relative strength index. And with the default setting, and all of these indicators come with default settings. Sometimes you can move them to different numbers to get a better idea for a particular security you're looking at. But this is just a default setting, and it shows how far this thing has moved in 14 days. So if it's moved enough and the blue line gets above this horizontal red line, it indicates overbought conditions. Same thing with back here. If this blue line gets above this horizontal red line, it indicates overbought conditions. And as you can see, both times were followed with sell-offs. So we're getting pretty close. If it gets up there, we could be looking at another sell-off. This is our energy sector, the XLE, and oil's been coming in pretty good. Yeah, so this is going to kind of follow oil. Oil's made a decent move lower over the last few days. I was expecting it, but it was even more dramatic than I thought it would be. I thought it would find support around 82. But if you check out my blog, you'll probably find something there about it. So if XLE does keep going lower, where are we going to look for support, right? And you say to yourself, you know what, I'd like to buy XLE, or I'd like to buy energy stocks, like maybe ExxonMobil, but I don't know if I should or not. Well, it's no guarantee, but if this trends lower and it gets down to this former resistance level, there's a good chance that it finds support, and that would be a lower risk place to buy than if you're just randomly guessing. What's that? Oh, all right. Mr. McCormick wants to show you his house, which has a uncanny resemblance, at least to me, to the Munster's house.
Yeah, I bought this fancy house down in Chicago. Pretty nice. Say you have a happy wife, you have a happy life. So I got a haircut, trim my beard up. Listen, ladies, this is for you. Is it still the same 140 years later? You got to have a happy wife, you have a happy life. Tell me the truth now.
All right, very cool. Wish my house looked like that. I knew this guy who I used to work with who was from such wealth that he grew up in a castle in Holland. I think it was Holland. And it was so big that even though he grew up there, there were rooms that he had never been into in his entire life. And he was the first person in his family in 7 generations to actually work. And you can't really call it work because it was his family's money, managing his money, his family's money was his job. But anyway, you could see support becomes resistance here. When markets are trending higher, they don't go in straight lines. They are kind of like a staircase. And each trading range, or it's a succession of trading ranges that are, one is higher than the one before it. And what was the top of the trading range becomes the bottom of the next range. But it's, again, it's the resistance turning into support, and we have support turning into resistance. This is the real estate sector ETF. This thing is kind of working out exactly as we thought it would be. What was support became resistance, and this is long-term support. If you look back on this chart, we're not going to do it today, at least not here in the newsletter, but you can find it on our blog probably, that in the early 2020, this is the same level that XLRE found support, and once again, it found support here. So this is a perfect example of market memory, and we see our support turning into resistance. So a really valid strategy would be, hey, this thing's at long-term support, let me buy it. Hey, if it gets to this former resistance level, let me sell it. So it doesn't need to be that complicated. All right, everybody. So last but not least, we have the materials sector, and this is a longer term chart here. This one goes 18 months. And we can see our concepts of support becoming resistance, support becoming resistance, support finding support at a prior support level. And notice this upper Bollinger Band, which we talked about before. Again, this is 2 standard deviations above the 20-day moving average. So over the past 18 months, each time it's gotten that high, it was a good time to sell. And now we're overbought and we're at a former resistance level. So 2 principles of markets that can really lead to success is understanding the concept that when a market is oversold and it gets to support, it tends to bounce. When a market is overbought and it gets to resistance, it tends to sell off. And that's what happened here. And that's what may happen here. And we could see this, it's hard to see, but in here is what we call an exhaustion, what might be an exhaustion gap. And this comes from people who are just sitting on the sidelines. They want to buy it, but they keep waiting for a better price. And it just keeps going higher and higher and higher. And finally they say, you know what, I'm sick of watching this. I'm just going to go in and buy it. I don't care what I have to pay. And those, unfortunately, are usually the last people to the party, so to speak. So, yeah, so there's a good chance we're running into some pretty good resistance there. All right, so this is kind of just an overview here. Understanding the trends, levels, and momentum is the key to profitable trading. So I'm going to make this so you guys can print it out. And at this point, Mr. McCormick wants to come on again and just tell you about some of the philanthropic work he did that he's very proud of. He was a religious man and put his money to a lot of good causes.
As many people back in my day, I was a Presbyterian. I was an advocate of Christian unity, and I believe that you should demonstrate that in your life. The Calvinist traits of self-denial, sobriety, thriftiness, efficiency, and morality. I believe feeding the world, and that made my reaper made that so much easier. And once I invented that reaper, it became part of my religious mission in life. I was a principal benefactor and trustee of what had become the Theological Seminary of the Northwest, which is known as Chicago's Lincoln Park neighborhood in 1859, a year after I endowed 4 professorships. The institute was renamed the McCormick Theological Cemetery after my death in 1886. It was moved to Chicago's Hyde Park neighborhood in 1775 and began sharing facilities with the Lutheran School of Theology in Chicago. And in 1869, I donated $10,000 to help Dwight D. L. Moody start the YMCA, and my son Cyrus became the first chairman of the Moody Bible Institute. And I don't know if you know it, but today you can still hear Moody Bible Radio all over the country. I also donated significant sums to Tuscaloosa College, a Presbyterian institution in Tennessee. Also established churches and Sunday schools in the South after the war, even though the region was slow to adopt my machinery and my practices. Also in 1872, I purchased a religious newspaper called The Interior, and I renamed it The Continent. It became a leading Presbyterian periodical. For the last 20 years of my life, I was a benefactor and member of the Board of Trustees at Washington and Lee University in my native Virginia. And I think the most impressive thing was that they put me on this stamp. How about that? 3 cents from a Cyrus Hall McCormick picture. Boy, I should have got a penny of that. I don't know what they was thinking.
All right, thank you for that. And with that, I just want to wrap things up. So here's me. Well, this isn't me riding this McCormick Reaper, but I got pretty good experience. Well, actually, I have great experience, but whatever. Worked for Cohen, Steve Cohen, Mario Gabelli. These are two of the best people around. If you don't believe me, just Google them. Cohen now focuses on, I guess, managing the Mets. Gabelli brought me into the industry at a business school back in the 90s, so I'm going to be forever indebted to him. He's also the head of trading at 3 different money managers, where I oversaw the trading in various products like hedge funds, mutual funds, all sorts of stuff. When it comes to trading, there's not much I haven't seen. I was a market maker, and this is just kind of a joke down here because a lot of retail traders think that hedge funds and market makers are evil and they're out trying to take a little advantage of the little guy. And the reality is that's just not the case. So if you want to learn more about that, you can subscribe to StockJobber.com. All right, everybody. That ends it for now. I will see you next week.